Hello, everyone. Richard Green here again, talking about our topic for week two, which is mortgage participants. And I think I should be a little more specific when I say mortgage participants when we're talking about who supplies mortgages. Obviously, people who borrow are also participants. We're not going to talk about them quite just yet, but we're going to talk about the process that gets money to the people who want to borrow it. And it's not as straightforward as most people think. I imagine that most people think that when they get a mortgage, they go to a bank. The bank has a bunch of money in it. They give the people the money with the expectation that it get repaid. That used to be the way things worked in the United States until about the 1970s, but now we are largely a capital markets financed mortgage system. And we're going to talk about that. And we're going to talk about how is it that the person who you interact with to get a mortgage deals with the people who are actually going to fund that mortgage? So that's what we mean by mortgage participants. So with that, let me share um, screen. There we go. And okay. So let me start by telling you about a really great resource. The Urban Institute puts this out. Full disclosure, I'm a non-resident fellow of the Urban Institute. A number of my students now work at the Urban Institute. A current student of mine used to work at the Urban Institute. So the point is, I do have pretty close ties to these people, and so maybe prejudice, but they do put out something called the Housing Finance at a Glance monthly chart book. This is the link to it, and every month they update information about the state of the mortgage market in a very useful way. And we're going to talk more about this chart book in a couple of weeks. But I am going to refer to two things from it today. And this is something you should be very familiar with if you're interested in the mortgage market. So let's start by talking about who originates loans. So, who are the people that you interact with when you are applying for a loan? And as I'm about to show you, more often than not, it is brokers. It is people who do not have money themselves, who are basically looking for loans to sell to the capital markets. So they are basically a market maker. They are the intermediary in between the supplier of the money and the demander of the money. Okay, and we're going to talk a little bit more about that. Sometimes these are known as TPOs or third-party originators. Correspondent lenders. These are people who have basically been given the authority on behalf of usually a bank to make loans. But the expectation is that once again, the loans are going to be sold into the capital markets. And you can sort of think as a bank as being the backup if it doesn't work for capital markets, the correspondent lenders make the loan. Uh, if that were to happen too often, they would cease to be correspondent lenders. And then finally, direct lenders. And that's who I think most people think about when they think about lending. It's people who have deposits, banks, savings and loans in the old days, and would take those deposits and use it to fund mortgages. So let's see who is actually doing the lending right now. So if we look at origin non-bank origination share, so these are the share of loans that are being made by non-banks that are being funded by Fannie Mae, Freddie Mac, or Ginnie Mae, and we're going to talk about them in a moment. You could see that currently about 83% of all loans are being made by non-bank lenders. And the largest lender at the moment, or the largest, I should say, originator at the moment, because they're not technically a lender, is Rocket Mortgage. And Rocket Mortgage is famous for buying very expensive ads for the Super Bowl. They are really a big dog. And the interesting thing about them, if you're a consumer, is they are providing service at a relatively high price. So it's almost always the case that you can get a loan with a cheaper interest rate if you go somewhere else. But what Rocket does, because of their sophisticated algorithm, is give you an answer about whether you're going to get a loan or not very quickly, sometimes within 30 minutes relative to other lenders. Okay. But you can see, again, about 83%, 84% of loans that are sold into the secondary market are originated by non-banks. If you look at Ginnie Mae loans, and I'm going to talk about what they are in a few minutes, it's more than 95%, Fannie and Freddie about three-quarters of all loans. Okay. And if you go back just as recently as 13 years ago, you could see that non-bank share was considerably lower in the neighborhood of, I don't know, 20 to 40%, depending on the type of loan product. So we'll talk about a little bit why that is in a moment. Okay, so who funds loans? Fannie Mae, Freddie Mac, and Ginnie Mae have a substantial majority of the business right now. Then you have banks, Citibank, Wells Fargo, your local bank, etc. Insurance companies a little bit, but usually nowadays through Fannie, Freddie, Ginnie. Pension funds a little bit. When you're looking at the commercial market, pension funds are very important in that market. Insurance companies and banks are too, although a little less so. Private equity is increasingly in the loan business, and we're going to have a whole class devoted to private equity. So we're not going to talk about that much today. And finally, mortgage REITs, which are publicly traded companies that are in the business of just buying and selling mortgages and trying to make money for their investors that way. And we'll talk about them again later. Today, we're really going to focus on Fannie, Freddie, Ginnie, and banks. Now, why is it that banks have such a small share of the mortgage business right now? Well, it's a couple of reasons. First of all, is from the standpoint of a bank's balance sheet, a fixed rate mortgage is not a good investment. And we've seen the reason for this quite recently. And this is the reason why Silicon Valley Bank got in trouble, why First Republic got in trouble, and so on. So banks borrow from depositors, and sometimes the rates at which they borrow are very low. 5 years ago, it was basically nothing. So they make a mortgage, they keep it on their balance sheet. 2.5 years ago, excuse me, 5 years ago, that mortgage rate may have been 2.5%. A bank is making money on that spread. So they're basically borrowing at nothing. They're earning 2.5%. So that's a 2.5% spread. And here's a handy formula to you. If you take the spread between borrowing costs and investment returns and multiply it by a leverage ratio, you get your return on equity. Okay, banks are generally levered about 10 to 1, which is to say that the amount of investment they have is 10 times the amount of cash that they have in the bank. Okay, and the definition of cash is retained earnings plus money that they take in with stock offerings, stock issuance. Okay. So they have that 10 to 1 ratio. They were making a spread of 2.5%. So that's a 25% return on equity. That is really, really good. But here's the problem. Okay. Remember, those 2.5% loans usually had a minimum fixed rate of fixed term of 10 years, and more often than not had terms of 30 years. Excuse the phone ringing. So what's happened to interest rates since then? Well, short-term rates have gone up by more than 350 basis points, 3.5%. Okay, remember they were making a positive spread before? Now they are making a negative spread. Okay, their return to the investment, that 2.5%, is less than the cost of borrowing to them. And sometimes that cost of borrowing is now 4. So here is, by the way, one of your exercises for today. I want you to go to a website called Fred, which is from the St. Louis Federal Reserve Bank. And I want you to graph mortgage rates and federal fund rates on one graph and see how there's been a difference over the years in the gap between the two. Okay, coming back to banks. So the problem for a bank is that once those borrowing rates go up above the fixed rate mortgage, they're now losing money, losing quite a lot of money on those mortgages. And that was, in fact, one of the key components to Silicon Valley Bank, which went out of business, and First Republic Bank, which went out of business, to them going out of business. Okay. So that's one reason banks generally are not in the fixed rate mortgage game anymore because short-term rates are too volatile for them to do that. The second thing is liability. This is something that Jamie Dimon has talked about. He says he really doesn't want JP Morgan Chase to be in the FHA business anymore. And we'll talk about what FHA is in a bit. Because if it turns out you made a mistake in underwriting that FHA loan, Federal Housing Administration loan, the insurer of that loan, which is the Federal Housing Administration, can come back and require you to not only eat that loan, but to pay what's called treble damages back to the FHA fund. And so Jamie Dimon decided that that risk wasn't worth it. He actually said it out loud. I think other banks have been quieter about it, but it's why banks are really not in the FHA business anymore. Okay. So we overwhelmingly rely on these entities called Fannie Mae, Freddie Mac, and Ginnie Mae. Okay. And so here, if we look at the volume of securitized first lien loans, overwhelmingly, if you look at the gray and the sort of blackish brownish line, you will see that that is a majority of the loans being originated. Blue, there's a little sliver of blue. Those are things called private label securities. They were a very important part of the market during the mortgage bubble of about 20 to 25 years ago. You could see now that they are a tiny fraction of the market. And then the remainder are portfolio loans. Okay, so who is going into those portfolio loans? Is there are loans that don't qualify for Fannie, Freddie, or Ginnie treatment because there are limits on how big those loans can be. The idea is because Fannie and Freddie are actually now owned by the government. They weren't before 2008, uh, except that Fannie was before 1968, that only a certain segment of taxpayers should benefit from them. And Ginnie Mae is completely backed by the federal government. Okay. So, um, all right. So what's the difference between all of them? What Fannie and Freddie do is provide private mortgages and guarantee the mortgages themselves. You could think of Fannie and Freddie as companies that do securitization and provide insurance. So what they do is they will gather a bunch of mortgages up, turn it into a security, and say to the investors of that security, you don't need to worry about being repaid because we will guarantee your repayment. Okay. Fannie and Freddie issue their own securities. Okay. Sometimes there are securities that have both loans bought by Fannie and Freddie in them. That's a relatively recent phenomenon. But think of Fannie and Freddie as sort of aggregators. They take a whole bunch of mortgages and they will go into the market and try to sell them. Or more frequently, actually, they will say to the market, give us money and we will find mortgages to fill in your security with a certain rate. What Ginny does is something different. Is Ginny doesn't guarantee mortgages because FHA, Federal Housing Administration, VA, Veteran Administration, and FMHA, Farmers Home Administration loans or farm loans are guaranteed by the government itself. It's the loans that are guaranteed, not the securities. But what Ginny does is guarantee that if something goes wrong with these loans, there won't be a cash flow problem for the investors in these loans. And I'll talk more about that later. So, and as I already said, Fannie and Freddie are issuers, Ginny is not. Okay.